Hi there and welcome to Hardman Talks. I'm Larissa Adams from Hardman Co, and today I'm going to be talking to our media analyst, Derek Terrington. Derek's had an extensive 30-year career with experience working at leading brokers and financial institutions. Earlier this year, he wrote a topical insight piece called Streamers versus Broadcasters. It details the slowing of the streaming growth in the North American market, whilst UK broadcasters reported a strong advertising recovery in the third quarter of 2021. Since our last chat with Derek, Netflix released a disappointing update in the first quarter of this year, reporting a potential loss of 200,000 subscribers. This marked the first time streaming giant has lost subscribers in over 10 years. So we're back here with Derek to find out what these new updates mean for the sector and if there are any changes or updates to his views. So Derek, it's great to welcome you back here to Hardman Talks. How are you doing today?
I'm well, thanks. Good to see you again, Larissa.
Okay, great. So let's kick off. So the Netflix Q1 results in April and the somber outlook for Q2 with the possible fall of 200,000 subscribers, it's still sending shockwaves through the tech sector whilst raising big valuation questions. So is there scope for recovery or have longer term perspectives changed?
Well, you're right about the reverberations that went through the market, not just in the media sector and not just in the highly rated tech stocks, but throughout the stock market, really. People began to look at the higher rated shares again. And also some of the private equity activity has also taken a knock because valuations there were just as high as in the secondary market. So, yes, from top to bottom, there's been a reevaluation of what sort of companies can really grow in future, I think. But in Netflix's case, there's a lot to talk about in detail, but I think that the basic business model is really unchanged. They've had to consider that their subscriber growth targets have been halted or at least compromised by short-term events, but they do have a longer-term strategy for building up content to renew subscriber and revenue growth.
Okay, so the Netflix Q1 results with their revenue uncertainties, it led to the company proposing to tap advertising markets. Is their business model broken, or is this an attempt to drive subscriber growth at the cheaper, i.e. ad light end of the markets?
No, it's very much about widening the range of price points and looking at the lower end. They have to tempt back into their business the subscribers who were getting it for nothing in the first place. And there are about 100 million of those. So what they have to do then is start to tease them back in. And the best way, they think, is to offer them a lower price. But that will be sustained as far as they're concerned by factoring in advertising to that particular offering. They do therefore have a wider range of price points. And other people like Disney and HBO have also tried this strategy, and it seems to work for them.
Sure. Okay, well, Netflix had a strategy of making their offering to subscribers more attractive by acquiring businesses in adjacent markets, for example, gaming. Companies in other media markets are following the strategy, like the New York Times buying sports information. But has Netflix actually abandoned this idea?
No, not at all. In fact, they're pushing it further forward. They have to make sure that their offering to the subscriber is very attractive, more attractive than the competition. And what they're really doing is broadening out the range of content that subscribers will pay for. They're investing a bit more in their own movies. They think they've not been good enough there. They're adding games, as we said. They're also looking at other ideas, like Formula One, and they really want to build up a great supply of top quality content to get subscriber growth going again, and therefore to get revenue growth going again. So there's a lot going on there, but it all comes back to the basic business model, as we were saying, pushing subscriber growth as far hard as you can. Although there's one sort of reservation I'd have there is that you can't continually drive subscriber growth. Even though globally they think that the opportunities are about the same as they were, but they will be a focus more and more on driving revenue, and that will really rest on subscribers being willing to pay for more content or better content or content that interests them more, and therefore that enables price points to shift up. So that would be the long-term gain. In the short term, they have to cope with the need to make all those changes, and that will require spending.
Right. Okay. Thank you. So I guess investor attitudes to risk can change swiftly. And now the focus is much more on profits and cash and much less on highly rated growth companies. Do you think this is justified?
Well, it's amazing how investor attitudes shift, isn't it? I mean, they were really piling into Netflix, and it got it up to a really high rating. But then when the story was seen to be flawed, certainly in the short term, the share price tanked. It fell about 35% on the day in which they announced those results. But as I was saying, I think underlying the business model is intact. But there was a great reassessment of valuations across the piece. There was a great reassessment of valuations of unquoted stocks. And so people have been thinking harder about what they want from companies generally. And yes, it comes back to, are you making profits? Are you likely to make profits soon? How is your cash flow? So, in a sense, there's been quite a switch away from these high growth stocks. But, there will be a time to go back into them when we've got a bit more uncertainty. And I think we've got not enough uncertainty, perhaps, at the moment, or enough certainty, I should say, because of the uncertain economic outlook. That's really what people have got their focus on at the moment. Consumer spending, where is that going? Inflation's going up. And also, people are spending less on a lot of things, including subscriptions.
Yeah. And I guess while we're on this, should investors really be looking to buy back into the best companies with sound business models? What do you think?
Yes, definitely. That usually works out. And historically in the media sector, if you've had a well-run company with a good business model that has an accident, if you say, perhaps something goes wrong, but it has a good management team and has good prospects, then it's always been right to buy back into that sort of business. I think that's really what's going to happen here. It may be too soon, but really in stock markets, is being too soon that much of a problem? It's always difficult to find the bottom, but if the business is sound and the cash flow is good, then it's good to go back into that sort of operation.
Okay, well, just changing direction slightly. So subscription revenue has long been a sort of holy grail for B2B companies. In consumer markets, an increase in subscribers is generally profitable growth. For example, the New York Times, with consumers willing to pay for quality content. But consumer subscriptions can be cyclical. And in the UK, surveys revealed that nearly 4 out of 10 people had cancelled a subscription recently, with half of these being TV streaming services. So do you think that the bubble has burst?
Well, there has been some bubble bursting, you're right. I think that people had indulged themselves somewhat in taking out subscriptions to various sort of services. And perhaps if you had 4 subscriptions, you cut back to 2. But that's not really surprising. There has a lot of sorting out to be done in the marketplace still. Consumers now are facing pressure on their spending. And so they will trim back. But subscriptions, yes, they will take a little bit of a squeeze in the short term, I think. But again, the market is looking at what is the best service. People will look at what's really attractive, and they're going to come down to the service with the best content and the most desirable long-term content in their view.
Yeah, absolutely.
Mm.
And collectively, streamers are set to spend 100 billion on content this year.
Mm.
Is this also another bubble waiting to burst?
Yeah, that's an interesting question because there's been a huge commitment to content spending, as you know. I don't think that it's really a bubble, but there may be some contraction in that spend. But don't forget, it's a very competitive market. A lot of people pushing into it as hard as they can, and I don't see any sign yet of them starting to withdraw. So the most important thing to do is to keep spending and to keep your content offerings strong and to keep tempting in those consumers. So I don't think that's a bubble, and I don't think it's going to weaken, if at all, in the short term.
Yeah. Okay. In the UK particularly, TV continues to drive into the streaming market. ITV has created ITVX, but investors are still skeptical. Do you think that this is a justified reaction?
Well, of course, investors are very, very uncertain about the trend in linear advertising, and the ITV has done exactly the right thing strategically, but of course that strategy has yet to bear fruit. So they are moving further into the digital market, and they've declared quite clearly that they will continue to move further into that market, which is strategically the right thing to do. But we have to see some results, I suppose. It's always a question of looking at the growth side of the business and looking at the linear side, which a lot of investors consider to be the non-growth side. But it's a company that's really taken a grip on its future and will continue to push into the digital market, but investors will wait for evidence of success.
Yeah.
Mm.
Okay. And our last question, I guess Channel 4 has successfully built up its streaming interests, but will the strategy continue if it's sold? And I mean, do you think it should be sold in any case?
Channel 4 is having a good time building up its digital offering, and they have a good percentage of their revenue coming from digital advertising, and they have a 3-year strategy which is to double the size of their digital business. They're very clear on what they're doing, and they have built up a business model that works, and it'll work in the digital space as well. So it's a really interesting question as to why they're being told by the government that they should sell. They should be sold. I personally think that the model is unique and that they should be allowed to continue. I don't think that selling them is really going to achieve anything for the channel. You could possibly devise ways of supporting them a bit more financially. Maybe the government could guarantee loans to the business, but I don't think, for example, trying to float it would be the right answer. You wouldn't get a good price. Nobody really knows how to value Channel 4 anyway, and you get a couple of vague numbers chucked out into the marketplace, and they don't mean anything. But if you could guarantee its remit and perhaps a bit more government support, and perhaps even let the government take a dividend out of the business regularly, then you might have a different situation altogether. I don't think it should be privatized, but the government should possibly look at making sure it's guaranteeing its success, and then with, as I say, take a dividend from it regularly. So no, please don't privatize it.
It's an interesting view.
Mm.
All right, Derek. Well, I think this is all we've got time for today. So I think that concludes our questions. And but yeah, it's been very, very interesting and very helpful. So thank you for coming on Hardman Talks, Derek.
Pleasure.
Thanks. And to our viewers, please don't forget to like and subscribe to our channel. We appreciate your time. Please do share your comments below and hit that like button. Otherwise, we'll see you back here on Hardman Talks next time. Thanks again.